Hello, friends. Welcome to Nirmal Bank. I'm Piyush N, and we keep bringing to you our series of conversations with market specialists, fund specialists, sector specialists, and market veterans. And today we are bringing to you a person who is no stranger to the banking industry, a well-known thought leader, a multiple book writer, and also a person who is on boards of many esteemed institutions also. And I'm talking about Mr. Tamal Bandyopadhay. Uh, Tamalji basically is a person who is well known in the industry. He's also the founder and editor of the news portal The Wire Business. He has written extensively for many magazines, newspapers, has authored many books, and we were just discussing with Sir about his latest book, which is A Roller Coaster and After with Banking. We'll go on the book also during the show. But first things first, and right now the banking sector is in the limelight for all the reasons. We started with the sort of exposure linked to Adani Group. The market started sort of finding out whether there is an issue in the Indian market. Then we actually slowly started moving in our recent sort of March developments, where the US banking developments also sort of caught attention for the global markets. We saw again SVB. That bank, basically, the UK arm was made by HSBC. There was a fallout of 2-3 banks in USA, what it implies for us sitting here. So a lot of things to be covered. And let's start our discussion first, straight away, on the US development. And then we'll go to the Indian markets. Tamal sir, you are sitting in USA right now. So let's first talk about the USA banks. What's the sort of feeling there? And what is your assessment? What is happening there?
No, I mean, nothing new to add. But from the India perspective, I think the analysts and the community of analysts, I think and the market participants are a little overreacting because our context is very different. No, it's not the difference between football and soccer. It's baseball and football kind of stuff, because the way the US interest rates have gone up over the past 1 year. In March last year, US Federal Reserve started hiking rates, and you see the Indian rates, the rise in interest rates, Indian rates. Yes, we also have gone up, but not to the extent the US Federal Reserve has gone up, has raised the rate, because the inflation is a much bigger threat here than in India. That's point number one. Point number two, this bank which collapsed and of course which was rescued, and it's very Indian way of doing. On Friday, there's the Deposit Insurance Authority stepped in, and over the weekend there's a backroom discussions, and the deal was stitched. On Monday everything was fine. I mean, a business as usual for the bank. So it happened in India. We have seen whenever the bank rescue happened, that's how it happened. But this bank is a very different kind of beast. It's a 40-year-old bank. It's primarily for the tech startups. Now, how did it fail? It took a risk in that funding state tech startups, which the Wall Street banks were not doing it. But the problem did not emanate from there. The problem emanated because it was flooded with money, the deposits, in the past 2 years, and it was parking the deposits in the US long-dated bonds. And when the yield started rising, definitely the value started eroding. That was the context. And then what added fuel to the fire is this fintech, the startups. They started actually knocking at the bank's door for easy. They used to park their money with this bank, but they started raising they started withdrawing the money because their funds flow, like the investors, etc., are not very forthcoming in the past year or so. So the fintechs, the startup fintechs, they started withdrawing their own deposits. And when that happened, there's a asset liability mismatch. So this bank had no choice but to sell off, and which was a technical M2M losses, mark-to-market losses, became a reality because once it says it started selling off the bond, there's a big hole, and it needed capital to fill in the hole. And there was nobody was willing to fill in the capital. So one thing led to another, and then there was a run on the bank. So this is a very different kind of situation. If you see the Indian context, our guys are not flooded with deposits. Actually, they are struggling for deposits. Our credit load is much, much higher, and there's a war for deposits among the banks at this point of time. So the context is very different. Our banking issues are very different. I think our reaction of the Indian market to this is a bit exaggerated. Having said that, theoretically, there are two very important issues which are relevant in India too. One is this the mispricing of risks. I understand that some of the banks have been mispricing risks. If you see the credit growth is a decadal high, which is close to 20%. As we speak, I think 16, 17% odd. And within that, if you look at the personal loan growth, which includes mortgage and FMCG, etc., is my understanding is between end January 2020 and end January 2023, in the past 1 year, is 20% plus, while the loan to corporates 7% odd. So are all the banks well equipped to manage the risk? Because when the interest rates are rising, the borrowers will feel the heat, and there's a possibility that everybody won't be able to service their loan. I mean, what you do, either you have to pull in more money for the EM to meet the EMI, or you need to stretch the tenure of the loans. But there's a limit to what extent you can stretch, depending your age and so many other factors and all. So I think the asset liability mismatch and the mispricing of risk, which we'll talk to that later when we talk about Indian banking system, banking scenario, is also relevant for India. Maybe not to the extent of this bank which they faced, but some of the Indian banks might face that. Not that they would collapse, but the NPAs will go. And other part is this, even though our inflation, again, more than 6%, which is the higher end of the inflation target band, Reserve Bank of India will now circumspect, think deeply before the next rate hike. Till yesterday, we were all talking, till yesterday meaning theoretically, I'm saying, till recently, we were all talking about yet another rate hike in April. It's bound to happen. RBI can't stop at 6.5 when inflation is exceeding 6%. But learning from the crisis, I think not only Indian bank, even global central banks now they have to they have to think deep to what extent the policy rates can be raised.
Absolutely, and that's a valid point here. From that perspective, do you believe that we have actually seen the peak of the interest rate cycle in USA also? Because
Yes, certainly not. If you see the latest inflation number, I think the US Federal Reserve has a tough job ahead. Certainly not. It's not peak. The rate will go up. But to what extent we need to see? Probably my bet is 25 bips.
Just continuing on the same point, when we're talking about the risk management here, the risk management from that aspect, where are we actually seeing some real risk? Is it more about the mid-sector PSU banks, or is it more about the private banks, larger banks, mid-sized private banks, where you actually are seeing some sort of red flags?
No, there's a mispricing of risk. That's what I'm hinting at. Now, till now, if you have seen the past few quarters, every quarter is better than the past quarter, the previous quarter, in terms of banks' earnings. That's what is happening. Now, why was that happening? One is, of course, the net interest income has been on the rise. Because the banks, as you know, that they're pretty fast in passing on the whenever there is a Reserve Bank of India rate hike happens to the borrowers, but when they're pretty stingy about the rewarding the depositors, passing on the benefit to the depositors. And the other part is this: only the new deposits get the new rates, while the entire loan book gets repriced, right? So what was happening is the if you see, about 40% of the loan portfolio of the bank system is linked to the external benchmark, which is either the Reserve Bank of India repo rate or the 364 day treasury bill. Now, all these rates have straight away gone up by 250 basis points, because that's the interest rate hike by Reserve Bank of India between May 2022 and now, from 4% to 6.5%. So 250 basis point rate hike passed on straight away. And the other 60% of the loan are linked to the marginal cost of fund, or the MCLR based. So that also gone up, not to that extent, but to a large extent. But the deposit rates have gone up not as much as the loan rates. So, and again, as I'm repeating, while the loan rates go up, the entire loan portfolio, the outstanding portfolio, gets repriced. But when the deposit rates go up, only the incremental deposit get repriced. So banks have been taking advantage of that. As a result of that, their NIM, the net interest margin, has been on the rise. That's point number one. Point number two is this: because there is no fresh slippages, and most of the banks have largely taken care of their NPAs by very high provision coverage ratio. You see the PCR of among the 12 banks, 12 public sector banks, I think 8 banks have between 80 and 90% of PCR. So they need to set aside less money for their bad loans. So that's by default getting the benefit. So that money was used for to adding to the bottom line. And third part is also banks were getting recovery pretty aggressively. So these three factors contributed to the very strong bottom line of the banks across board. And every quarter, as I said, is getting better and better than the previous quarter. Now, will this honeymoon and the romance continue? I would like to believe no. I think the March will be the last quarter where we'll see yet again a fresh high of the bank's earnings. But from June onwards, by June, the most of the bulk of the deposit portfolio will be getting repriced. So which means that net interest margin will be under pressure. That's point number one. Point number two is this: my understanding is banks, at least the certain banks, are seeing some kind of incipient stress in their personal loan portfolio, which means the home loan and other unsecured loans, as well as MSME loan, etc. And there I am talking about the mispricing of risk, because earlier what was happening is in 2000 till about 2014, 15, 16, what we saw is this bank's credit portfolio was going up, largely driven by corporate credit, and there was a hard mentality. Bank A gives loan, and then bank B, C, D, E also joined. Similar thing has happened in the past 1 or 2 years. That kind of hard mentality. Everybody will do home loan and auto loan and unsecured personal loan and all. Now, do they have the right kind of underwriting and the risk management? I'm afraid everybody does not have. So that's the mispricing of risk I'm talking about. And my understanding is this: from the coming quarters, we will see certain cracks. Have the turn NPAs, the fresh NPAs? I don't think so. As technically a loan, if it's not serviced beyond 90 days plus, then only it becomes NPA. But then there's SME1, SME2, SME3, etc. while you are not being able to serve for 30 days and 60 days and 90 days. So my understanding is this: some banks are seeing incipient stress, and loans are through the stages of SME1 and SME2, which mean 30 days overdue and 60 days overdue. It's particularly true of the unsecured loan, certain MSME loans, etc. Because the loan rates have gone up, and
Yes.
not everybody is capable of servicing the loan. So that's the stress I'm talking about, and that's the interest rate risk. I mean, that's the risk pricing, the mispricing of risk I'm talking about.
Well, that's a very insightful sort of outlook for us to really look forward to the banking stocks and also the banking sector earnings here. I'll now quickly move towards the sort of Dani Group event here. We have seen largely again from the perspective of the exposure, perhaps the total exposure to the Indian banking sector was slightly less the way actually market was reacting earlier. But what are your thoughts right now? Have we already sort of maturely accounted for everything? Is there some sort of risk which the banking sector is facing? What's the overall assessment of yours?
Prima facie, if we go by the numbers that we see, I don't see any risk for the banking sector. I mean, very little risk, because you see the overall exposure of the group is rupees 2 trillion plus. Now, much of it is from the overseas, I mean, the money raised from overseas. And from the banking system, I think it will be a little less than 80,000 crore, all banks put together. Now, what is 80,000 crore if you look at the total banking, the credit portfolio of the Indian banking system? It's about 60, 70 basis point, not even much less than 1%, right? So theoretically, if the entire loan goes bad, and they are not backed by any collateral whatsoever, even then, the industry's NPA will go by 65, 70 bits, not more than that. Now, go back to 2018. Between SR Steel and Bhushan Steel, have 1 trillion plus total exposure to the banking system, right? And the first 12 accounts which had gone to the IBC, I think 3 trillion plus their overall exposure was there. So from that perspective, if these numbers are true, now it could happen. I'm not saying it has happened. So there are Adani Group companies which have taken loan from the banking system, but that's not coming under, as of now, under the Adani Group in different ways they're taking loan. If that's the case, I'm not qualified to assess what's the risk about. And then there will be loan against shares, which are primarily, banks' market exposure treated as not as loan exposure. But my understanding is this loan against shares, bulk of it came from overseas, and certain percentage from the NBFCs, not from the banks per se. I hear a lot of stories like one particular bank has not only given loan, but even underwritten the loans, the bank itself. But as I said, I don't have the documents on my table. I can't say that. But prima facie, if we go by the numbers, I would like to believe that we shouldn't. We shouldn't exaggerate the kind of impact which it can have on the banking system.
Right. So that's about the numbers here, but on a top view, superficial basis, when we look at the businesses, either backed by very long-term assets like would be gas, would power, and ports and other assets, are these something which actually are really worth grabbing the headlines? Like, are these something which are really related to solid assets, the revenue getting generated, or you think that yes, there has to be some concern?
No, as I said, I'm not qualified to judge the quality of assets, but going by the pure numbers, which the banking sector's exposure to the group as of now it stands officially, I don't think there is anything to be worried about. Now, if there is something beyond these numbers, which are not in public domain, we need to see that. But as of now, as things stand, I think the fear and the apprehensions are over exaggerated. As I said, even if theoretically, as I said, which is not the case, entire thing turns bad and the group is not able to service the loan, there is no collateral, which is on one extreme, and which is not the case at all. Even then, the impact on the banking system is 60, 70 basis points. So what are you talking about?
Absolutely. So this is what I think viewers should remember. These actually are 60, 70 basis points again compared to the total overall banking system. So I think that's a very important point here. Now, let's go to something as we move towards the end of our conversation. The book which you have bring about, Roller Coaster and Affair with Banking, help us understand why you wrote this book. What are the thoughts actually when you were writing this book? What this book actually is telling us? Please help our viewers understand about it.
Well, don't take it seriously at all. This is my seventh book. My first book was released by then Finance Minister in November end 2012, and this book got released on January 10th, 2023. So in little more than 10 years, I've produced 7 books. During the COVID time, this is a second book. First book was Pandemonium, the Great Indian Banking Tragedy. Pandemonium, the Great Indian Banking Tragedy, it actually sucked my energy. I delved deep into data crunching, to look at what exactly gone wrong, the NPMS and the role of NBFCs, the banks, the rating agencies, Reserve Bank of India, etc. It was a very deeply researched book. So I want to do some fun stories, and using this again, the COVID window when your movement is restricted. Often you're sitting at home, and because if you want to go out, you need to wear your mask, and after a certain time you hate doing that. So that's the way the book was conceived. I call it creative nonfiction. It's all fun but not funny. It's all about psychology of bankers. It's not about interest rate, inflation, stability of the financial system. It's not like that. It talks about the central bankers and bankers. How are they as human beings, as persons? It's story of the kitchen, of their drawing room. I will not say bedroom, but kitchen, drawing room, and garden. How are they? But I repeat that, like Reserve Bank of India governor who did lungi dance on his farewell, or another governor who used to, in shorts, every morning used to get out and buy milk pouch for his mother from a kiosk, or yet another governor looking for idli while in Beijing. And a governor's wife, actually the mandate in the governor's bungalow, the governor's wife's mandate to the gardener was there every Sunday. The gardener must tell the madam how many limes are there in the lime tree. So those are the kind of stories about the central bankers. Similarly, about commercial bankers also, there are stories about their feudalism, stories about their both positive and negative, I would say. So I would not like to promote my book on your platform. So let's not make it a marketing pitch, a marketing effort. I mean, I don't want to say that, but the point I am saying that it is all fun. It's a creative nonfiction, but not exactly funny. The underlying meaning is, who is bigger, the bank or the banker? And if the banker at times project himself or herself as bigger than the institution, then the person has to pay a price. You call it hematia or hubris in Latin, and you pay the price. So that's the underlying meaning. I'm repeating. It's all fun,
Like the book.
not exactly funny. It's all stories about the psychology of bankers and psychology of banking. Creative nonfiction. I'm repeating it. A creative nonfiction. Most of them are named, but some of them are not named. Certain stories are not exactly palatable because my interest is not naming and shaming them. So I have not named certain persons, but most of them are named. All central bankers are named. Some of the commercial bankers are not named.
I'm tempted to ask you any particular interesting story actually which you want to share from the book with our viewers. Like there was a mention about a banker where actually they used sort of their own religious faith or before approving loans. Anything which you think should be very interesting.
Okay, thank you for giving me this opportunity. I'll just tell you 2 stories. One, yes, your subject, that's what you said, that you pointed out, is this particular banker told me that you think that we bankers are God's gift to the world, and we deal with money, and we are perfect about managing risk and giving loan to the right person. Come in, get inside. Then he took me to the sanctum sanctorum, that inside of his cabin, and then I found the idol of a goddess. I would not like to name the goddess because then you can imagine which community the banker belongs to. I don't want to say. But the banker told me, look, whenever there's a loan proposal comes to my table, I put it on the feet of the goddess. And if it gets stuck there, then the loan is approved. If it falls, the loan will not be approved. So accordingly, the risk management committee and the credit will do the credit appraisal. The goddess first decides whether the loan will be given or not. So that's goddess actually was the ultimate underwriter. But this I'm talking about 2 decades back. Banking has certainly changed. And other part is this: if that's the talk about religious belief and faith, faith in Almighty, that we can't do any risk management is actually in the hand of in Almighty. The other part is a sort of feudalism, I can call. So I used to have a lunch with a bank CEO. And on my first day, the executive assistant told me that here's the lunch room, go, but don't, there's only one chair, we find a small white hand towel on it. That's the boss's chair, you don't sit on it. Anywhere else you can sit. And then lunch started, the boss walked in, pretty fabulous lunch with all kind of non-veg, and being a Bengali, I was treated with rasgulla and sandesh and all. And this gentleman had the habit of having non-veg with green chilies. So he would chew his green chili, and he had a bald pate, So he'd chew his green chili, and it was so hot, he would start sweating. And one kitchen staff would stand at his back, would pick up the white towel and wipe the sweat from his head. And with a lot of pride, this gentleman told me, look, I don't allow this person to do any other work. His sole job is to wipe the sweat from my bald pate while he was eating non-veg and green chilies. So that's the ultimate feudalism, So as I said again, it's fun, but certainly not funny. Can you do that? Should you do that? That's it. So I took the liberty. You said 1, I said 2. There are dozens of such stories, replete with such. The book is replete with such stories.
Well, I'm truly enjoying this. I think it looks like a great sort of book to really. It must be like your 2-decade, 3-decade sort of different stories coming into the book, right?
Yes, it's not interview based. I started bank reporting sometime in 1995 when Rangarajan was the last leg, and the dividing wall between banks and financial institutions were being broken, and the interest rates, both the deposit rates and lending rates were started getting freed. The last lap of Rangarajan's innings, second half of 1995. So 1995. So it's more than 2.5 decades. It's all my personal interaction and interface. There's no interview done for this book, especially, and nobody knew what I was writing. So the persons who would find, after the book is published. And I must tell you one story, if you allow me, and if you have time permits. This story is, again, I named the person. This is the current ICICI Bank CEO. Now, when in his insurance days, one evening he found one of his colleagues, left office but not getting into his car, and so he asked that gentleman that what happened? Why aren't you driving back? And this gentleman has a phobia of driving, so he could drive his car. Somebody sitting next to him, not alone. That day he came from Goregaon to his office with his colleague sitting next to him, but unfortunately, by evening, that colleague had another meeting so he rushed out, and this gentleman is alone here. So he was wondering whether he would take the car drive back home, or he would take a taxi. He didn't have the guts to actually to take to the steering. Mr. Bakshi saw him, and he told him, "Look, you don't think about reaching home. Don't think about destination. Just look at the signal ahead of you. Look at the next 50 meters or 100 meters, and that's how you go. Don't think about the destination of the movie." And he made it, and he saw him off, this gentleman driving on the steering and driving, leaving the premises. And after he reached home, he got a call from Bakshi whether he has reached home. The gentleman said he has reached home. And he told me that that was not a driving lesson, that was a life lesson for me. I mean, because its destination is not important. The journey is important.
Journey is important.
You have to be careful about journey. And he said that evening, that was a monsoon evening in Mumbai, driving down to Goregaon, a western suburb. He said that evening his fear for driving went away. And after that, he started taking his car all by himself to the office and then going to Lonavala, Khandala, even driving down to Goa. So this is not a driving lessons, it's a life lessons. So the point I'm making is there are serious stuff as well, not this kitchen staff wiping out the sweat from the bald pate of the boss.
Absolutely. Yes.
It's not only about feudalism, it's about other aspects also, but all about psychology of bankers and psychology of banking, not inflation management and ROA and ROE and financial sector stability and balance sheet management.
Well, I think it's interesting to know the other side of the banker. So I'm very sure. I think it's going to be a book which I will look forward to read completely. But as you have given us all the insights, so thanks a lot, sir, for coming on the show and giving us insights across the board, USA, Indian markets, all exposures. And the end and the most interesting part for me is about your book. So thanks a lot for being on the show.
Thank you. Thanks, Piyush.
And with that, viewers, it's a wrap on this show. Hope you enjoyed it.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.